Picture this. It's like 2 in the morning on a Tuesday, just outside of Tokyo.
Oh, man. I know this story.
Yeah, and it is just pouring rain, the wind is howling, and sitting inside this tiny, aggressively illuminated toll booth is an 80-year-old grandfather.
Right.
And he's not there because he's bored and wants to, stay active in his retirement. He's there because if he doesn't work that 10-hour night shift collecting coins from passing trucks, he literally cannot pay his heating bill.
It's a terrifying image, honestly. And it's one that really vividly opens the discussion in the text we're looking at today, specifically the Japanese translation of the Korean book on money.
Yeah, exactly.
What we were looking at there isn't just, a sad anecdote about aging. It's a symptom of a macroeconomic foundation that is fundamentally cracked.
Right, because we used to have this concept of the wealth ladder.
Exactly. The wealth ladder, it was a very predictable linear progression. You graduate, you get a starter job, you rent a modest place.
You park your surplus cash in a savings account.
Right, an account that actually earned a decent yield back then. And eventually, you use that deposit to buy a home. That was the tunnel to the middle class.
And if you're listening to this on your commute right now, whether you're, a 20-something just starting out or someone mid-career, you already know that tunnel is completely blocked.
Totally blocked.
So, welcome to Amateurology. We are looking at a bizarre paradox today. A generation ago, a public school teacher making a decidedly average salary could easily buy a 3-bedroom house by age 30.
Oh, easily.
Fast forward to today, and you have a software engineer making a top-tier 6-figure salary who is completely stressed out, renting a 1-bedroom apartment, and genuinely struggling to secure a mortgage.
Which naturally leads to, the overarching question of our era, right? Is it actually harder to get rich today, or have we just completely misunderstood the new rules of the game?
Right. What is our actual role in this new economy?
Exactly. And we are going to look at a massive stack of research today, from behavioral economics and deep actuarial math to, ancient financial parables.
We aren't here to give you a comforting yes or no. We really want to dismantle the mechanics of what is actually happening to your money, your psychology, and your future.
Because, complaining about the economy doesn't put money in your bank account.
It definitely doesn't. So let's start with that broken ladder. If the traditional rotational process of saving and buying is gone, what has replaced it?
Well, from a structural perspective, we're basically living in the era of the debt shackle.
The debt shackle.
Yeah. Let's look at the research on the simple path to building wealth. Historically, education was the undisputed first rung on the wealth ladder. It was the accelerator.
You bought the degree, and it mathematically guaranteed a premium on your lifetime earnings.
Right. But that math only works when the cost of the asset, the degree, is proportionate to the income it generates.
Which it's definitely not anymore.
No, not at all. The texts point out that the function of a university degree has completely mutated.
Mutated how?
Well, when the cost of a 4-year education spirals up to, $500,000 for certain private institutions, it stops being an accelerator. It becomes a heavy iron chain.
You have 22-year-olds entering the workforce with mortgage-sized debt, but no house.
Exactly. Let's run the actual math on that because it's devastating.
Let's do it.
If you graduate with just $50,000 in student loans at a 7% interest rate, and you just pay the minimums.
Which most people do.
Right, because that's all they can afford. You aren't just losing $50,000. You are losing the opportunity cost of what that money could have done in the market.
Because it's not compounding for you, it's compounding against you.
Yes. That monthly payment, if invested from age 22 to 62, could have compounded into over $1 million.
Oh, wow. Over $1 million.
Over $1 million. That is what the author means by a shackle. It literally robs you of your compounding horizon.
And it forces young people to cling to jobs they absolutely hate.
Right. It prevents them from taking entrepreneurial risks, traveling, or innovating entirely because they have to service this massive debt.
And that's just the education side, We have to overlay that with the housing data from the financial journals we reviewed.
The housing data is grand.
It really is. The 2008 financial crisis was this traumatic, systemic shock that pushed millions of families out of homeownership via foreclosure.
And dumped them straight into the rental market.
Exactly. And what happens when millions of people suddenly need to rent?
Demand spikes, supply is constrained, and prices just explode.
Right. Now, we are seeing a massive swath of the population classified as rent-burdened.
We always hear that phrase, right? Rent-burdened.
Yeah, usually defined as paying more than 30% of your gross household income toward rent.
But from an economic standpoint, is that 30% metric even mathematically viable anymore? Or is it just this outdated artifact from the 90s?
I think it's completely obsolete. I mean, the 30% rule was conceived in an era where inflation was relatively stable.
Right. And the remaining 70% of your income could comfortably cover groceries, healthcare, transportation, and still leave a margin for savings.
Exactly. But today, in a macroeconomic environment with volatile inflation and stagnant wage growth in real terms.
If you are paying 30, 40, or sometimes 50% of your take-home pay on rent, the math just completely breaks down.
It does. The research shows that 2/3 of these heavily rent-burdened families have less than $400 in liquid savings.
Less than $400.
Yeah, half have less than $250.
Which means they are like one blown tire or one dental emergency away from total financial ruin.
Exactly. And when you are bleeding that much cash just to maintain basic shelter, the idea of, investing for the future feels completely insulting.
It really does. But there is a third pillar here that makes the situation even more precarious, and that is the literacy crisis.
Right, the financial capability surveys.
Yeah, these massive national surveys. They asked adults basic foundational questions about interest compounding, inflation, and risk diversification.
And the results were not great.
The failure rates are absolutely staggering. Fewer than half of the younger respondents could accurately answer a basic question about how inflation erodes purchasing power.
So they literally do not understand the mathematical physics of the system they are operating in?
Exactly. They don't understand that if inflation is at 5% and their savings account pays 1%, they're guaranteed to lose money every single day.
I have to push back on the framing of this, though.
Okay, lay it on me.
We call it a literacy crisis, right? Which places the blame squarely on the individual. Like, you failed the test, you didn't study hard enough.
Sure.
But is it really the individual's fault, or has the financial system been engineered to be intentionally predatory?
That's a huge debate in the literature.
Right. Because if we bring in the perspective of common sense investing, the founder of Vanguard makes a really compelling case that the entire financial services industry thrives on manufactured complexity.
Oh, absolutely. The jargon alone.
Yeah, they use impenetrable jargon, hidden fee structures, and convoluted derivatives just to justify exorbitant management fees.
So you're saying if a system is explicitly designed to confuse you so institutions can siphon off your wealth, failing the literacy test isn't an individual failure.
Exactly. It's a feature of a predatory ecosystem.
That is a highly structural view. And behavioral economics absolutely supports the idea that the industry exploits our cognitive biases.
Like credit card companies.
Exactly. Credit card companies know exactly how to trigger instant gratification while hiding the long-term pain.
Right.
But if we swing too far into blaming the system, we fall into a trap that is aggressively attacked by the author of the text on teaching you to be rich.
I struggle with his approach sometimes, to be honest.
Really? Why?
Well, telling a single parent who is severely rent burdened to just, negotiate their cable bill feels incredibly out of touch with systemic poverty.
Yeah.
Can behavioral tweaks really solve massive mathematical deficits?
That's the tension, isn't it? But his argument isn't that systemic inequality doesn't exist. His argument is that complaining about it yields a 0% return on investment.
Okay, that's fair. A 0% return.
He has zero sympathy for what he calls victim culture. He constantly hears people say, I literally cannot save a single dollar.
Right, because everything is so expensive.
So he launched this 30-day, $1,000 challenge. He gave people highly tactical psychological scripts to negotiate car insurance, cut phantom subscriptions, and optimize their banking to avoid fees.
And what happened?
Thousands of people who swore they had no money suddenly found $1,000 in 30 days.
Wow. Just by optimizing their current cash flow.
Exactly. His point is crucial here. Yes, Wall Street is greedy. Yes, housing is historically unaffordable. But the game is not rigged beyond repair.
You just have to start playing by the 1980s rulebook.
Precisely. You have to take an active role in managing your own psychology.
Okay, so if the 1980s rulebook, go to school, get a safe job, buy a house, retire at 65, if that is burning down, we have to rebuild our baseline assumption.
We do.
What does it actually mean to be rich today? Because if you look around, the visual markers of wealth have never been louder, but the actual balance sheets have never been weaker.
It's because most people completely conflate income with wealth. And they are two entirely different mathematical concepts.
Let's pull from the research on the millionaires next door. This is a masterclass in shattering illusions.
It really is. The surveys they did are fascinating.
They conducted these massive on-the-ground surveys of upscale, high-income neighborhoods, fully expecting to find all the millionaires.
Naturally, you'd assume the guy in the mansion is the millionaire.
Right. But they found this glaring anomaly. People living in massive homes and driving imported luxury cars actually had astonishingly low net worths.
They were basically broke on paper.
Exactly. And conversely, the people with immense generational wealth rarely lived in those flashy neighborhoods.
The researchers categorized them into two distinct psychological profiles, which I love.
Under accumulators of wealth and prodigious accumulators of wealth.
UAWs and PAWs. They even give a formula for it, which is so interesting to run on yourself.
Oh yeah, walk us through the formula.
You multiply your age by your realized pre-tax annual income and divide by 10.
Okay, age times income divided by 10.
That number, minus any inherited wealth, is what your net worth should be, just to be considered an average accumulator.
The examples they use really drive this home. They talk about Teddy, a top-producing sales professional, and Mr. Norman, a high-level executive.
Oh, right. The guy's pulling in fire hoses of income.
Yeah, anywhere from $150,000 to over $1 million a year. But their net worth is practically non-existent outside of their highly leveraged mortgaged homes and depreciating luxury vehicles.
They use a great Texan colloquialism for them, right?
Yes. They say they wear big hats but have no cattle.
Big hats, no cattle. I love that. Let's think about this mechanically. Imagine your personal finances as a high-pressure hydraulic system.
Okay, hydraulic system.
Income is the water being pumped into the system at high velocity. Wealth is the actual pressure that builds up and is stored in the reservoir.
So you can have a massive industrial-grade pump pushing water in. That's your six-figure salary.
Right. But if your reservoir is riddled with leaks, $500 car leases, country club dues, a mortgage that eats half your take-home pay no pressure ever builds.
You have zero stored energy.
Exactly. You aren't rich. You are just a highly paid conduit for money flowing from your employer straight to the banks and luxury brands.
Wow, a highly paid conduit. That's a dark way to look at it, but it's so true.
And psychologically, that is a terrifying place to live because if that pump stops for even a month due to a layoff, the entire system collapses.
So if true wealth isn't a massive income spent on luxury goods, what is it?
Well, the text on choosing your money or your life offers a profound, almost philosophical shift in perspective.
Yeah, that money is not currency. It is not status. It is not power. Money is simply life energy.
This changes everything once you internalize it. Think about the mechanics of a job.
Okay.
You have a finite number of hours on this earth. When you go to work, you are literally trading the irreplaceable hours of your biological life for pieces of paper or digits on a screen.
The author challenges you to calculate your true hourly wage, right?
Yes, and it's brutal. It's not your salary divided by 40 hours a week. You have to subtract the cost of commuting, the cost of work clothes.
The expensive takeout you buy because you're too exhausted to cook.
Exactly. And the time you spend decompressing from work stress.
Right, so if you make $30 an hour on paper, but you factor in the commute, the taxes, and the work-related expenses, your true hourly wage might be like $12 an hour.
Yeah. Now let's apply that to consumption. When you go to buy a new smartphone for $1,200, you aren't just swiping a card.
You're doing the math.
At $12 an hour of true life energy, you are trading 100 hours of your actual finite life for a piece of glass and metal that will be obsolete in 3 years.
Man. When you view money through the lens of life energy, consumption suddenly carries a massive existential weight.
And that framework leads directly to the concept of the crossover point.
Tell me about the crossover point.
In this system, you are truly wealthy, not when you buy a yacht, but at the exact mathematical moment your passive investment income crosses over your monthly living expenses.
So if you need $4,000 a month to live, and your investments generate $4,001 a month,
You have achieved the crossover point. At that moment, you achieve total psychological and financial autonomy. You never actually have to trade your life energy for money again.
that is such a powerful milestone. Another author takes a slightly more aggressive modern tone with this exact same concept.
Oh, the FU money concept.
Yeah. Yes. The ultimate definition of modern wealth isn't a Rolex or a zip code. It is having enough capital stored in your fortress that you can look at a toxic manager, an abusive relationship, or a completely crashing economy and say, I'm walking away.
Walkaway power is the ultimate luxury.
It really is. But here is where we hit the psychological wall.
What do you mean?
Well, if true wealth is time, autonomy, and walkaway power, and high incomes don't guarantee those things, why do so many incredibly smart, high-earning people fail to achieve it?
Because you aren't fighting the Federal Reserve or the bond market. You are fighting your own evolutionary biology.
Exactly. Let's look at the mechanics of social comparison. Going back to the millionaire data, they illustrate how high-status neighborhoods actually operate as financial traps.
Because humans are deeply tribal.
Right. Our brains are wired to secure our position within the group by signaling our fitness. And in modern society, we signal fitness through conspicuous consumption.
So if your neighbor buys a new Tesla, your brain subconsciously interprets that as a drop in your own relative status.
Yes, and it triggers anxiety. It creates this toxic, self-perpetuating cycle where everyone is engaging in an arms race of consumption just to tread water socially.
And there's a tragic downstream effect of this, right? The economic outpatient care.
Oh, that part is so sad.
These high-status parents end up having to constantly subsidize their adult children.
Because the kids are raised in an environment of hyperconsumption, they inherit the expensive tastes, but they don't inherit the actual capital to sustain it.
So the parents are perpetually draining their own retirement just to maintain their children's false status signaling.
It's a nightmare. And the behavioral finance texts have a brilliant take on this. They argue that this happens because we operate on default settings.
Default setting.
Yeah. If you do not sit down and consciously engineer what a rich life means to you specifically, you will unconsciously absorb society's default definition.
I remember the example of the friend group.
Yeah, where one friend's idea of a rich life is dropping $500 on a Michelin-starred tasting menu without blinking.
Right, but another friend cares nothing for food and just values taking a month off to backpack across Asia.
And another values bespoke designer clothing. The math is clear. You can afford one or two of those things, but you cannot afford all of them.
Right, but if you don't aggressively prioritize your role in your own life, you open Instagram, see your food friend eating caviar, your travel friend in Bali, and your fashion friend in a new suit.
And your brain's loss aversion kicks in.
Exactly. You feel FOMO, fear of missing out on all fronts, so you try to keep up with all of them simultaneously, and you end up completely broke.
This connects to a much deeper macro-psychological reality that is unpacked brilliantly in the text on the psychology of money.
Oh, the generational trauma concept. I love this.
It's so insightful. It explores how our macroeconomic environment during our formative years literally rewires our brain's relationship with risk.
The thesis is that your personal experience with money makes up maybe 0.0001% of what has actually happened in the world, but it makes up 80% of how you think the world works.
Let's look at the Depression babies.
Okay.
People who came of age during the 1930s watched banks literally lock their doors and vaporize life savings overnight.
So they view the stock market not as an engine of wealth, but as a casino of total ruin.
Right. They hoarded cash under their mattresses. You can show a Depression baby 100 years of data proving the stock market goes up, and they will not care.
Because the neurological trauma of the breadlines completely overrides the math.
Exactly. And the author argues that today's younger generations have their own specific trauma.
The 2008 babies.
Yeah. If you came of age during the 2008 financial crisis, watched your parents lose their home and their dignity, and then entered the workforce during a period of massive inflation and stagnant wages.
Your trust in the institutional market is fundamentally broken. Your risk tolerance is completely warped.
Which pushes people into two extremes.
Right. Either they become overly conservative and keep everything in cash, letting inflation slowly bleed them out.
Or they swing to the opposite extreme. They dive into reckless, get-rich-quick crypto gambling or meme stocks because they feel the traditional slow and steady system is completely rigged against them.
Which brings us perfectly to the core of behavioral economics. Specifically, the groundbreaking work on misbehaving markets.
Oh, Feller's work.
Yes. For decades, classical economists, the guys building the models, operated on the efficient market hypothesis.
They assumed humans were econs.
Perfectly rational calculators who instantly price all available information into the market.
An author basically looked at that and laughed.
He really did. He proved that humans are not rational calculators. We're deeply emotional, biased creatures operating on evolutionary hardware that is totally unsuited for modern financial markets.
Let's look at the mechanics of loss aversion, which he built on.
Neurologically, the pain of losing $100 registers in the brain roughly twice as intensely as the pleasure of gaining $100.
How does that actually play out in the stock market, though?
It creates systemic irrationality. The research shows that investors systematically overreact to loser stocks.
So imagine you buy a stock and it drops 20%.
The psychological pain is excruciating. So instead of holding it and waiting for it to recover, your amygdala screams at you to stop the bleeding.
And you panic sell at the absolute bottom of the market.
Exactly. And conversely, you get swept up in market manias, like the dot-com bubble or recent tech surges, because the pain of watching your neighbor get rich overrides your logical understanding of valuation.
The FOMO is just too strong.
Right. The math of investing is astonishingly simple. The psychology of executing it is brutal.
Okay, so if we are fighting our own biology and the traditional wealth ladder is broken, you would assume that the absolute best financial minds, the experts writing these sources, have a unified, foolproof playbook to get us through this, right?
You would definitely think so, but when you actually read these sources side by side, it is stunning. They vehemently disagree on almost everything.
We are talking about total ideological warfare.
Let's dig into debate number 1, which I call extreme frugality versus die with zero.
Okay, the savers versus the spenders.
Right. On one side of the ring, you have the savers. The millionaire texts and the life energy texts advocate for intense, almost monastic frugality.
They literally advise you to track every single penny you spend down to the cent on a giant wall chart in your house.
Yes, you are supposed to embrace a lifestyle of scarcity, optimize every single dollar, and build your wealth through relentless, ironclad defense.
And on the exact opposite end of the spectrum, you have the concept of dying with zero.
The author looks at the extreme savers, looks at the math of human biology, and basically says, you people are ruining your lives.
He specifically targets the cultural phenomenon of the latte factor, right?
Oh, he mocks it relentlessly.
The idea that if you just skip your daily $5 coffee and invest that money at 8% for 40 years, you'll have hundreds of thousands of dollars.
He openly mocks it because he points out a tragic actuarial truth. Economists and demographic researchers know that older people do not decumulate their wealth fast enough.
Accumulate, that's a great word.
People spend their 20s, 30s, and 40s grinding and saving out of pure fear. They sacrifice trips, they skip dinners, they live in total scarcity.
And they end up dying at 85 with $2 million in the bank, too old, frail, or sick to actually enjoy it.
Exactly. So what's his mechanical alternative?
He advocates for the concept of memory dividends. He argues that wealth is meant to fund specific experiences in distinct biological seasons of life.
That makes a lot of sense.
Yeah, like taking 3 months to backpack across Europe and sleep in hostels at age 25 yields a memory dividend that pays out joy and perspective for the rest of your life.
But trying to do that exact same trip at age 75 with bad knees and a strict diet is just not the same experience, no matter how much money you have.
Exactly. His goal is mathematically literal. He wants you to optimize your spending so that your last check bounces on the exact day you die.
But wait, I have a question about that.
Yeah.
If he's telling us to spend our wealth to maximize life experience, how does that square with the unpredictability of the world?
That is the million-dollar question.
What if a black swan event wipes out the economy when you're 60, you lose your job, and you've already spent your capital on, memory dividends?
This is exactly where the math guys go to war over market strategy. Let's move to debate number 2, the indexers versus the extremists.
Okay, the indexers, the advocates of the simple path and common sense investing. Their core thesis is that trying to pick individual winning stocks or trying to time when the market will go up or down is a mathematical loser's game.
Let's explain the mechanics of why they say that. It's not just an opinion, it's structural.
Right. Whenever you buy or sell a stock, there are mechanisms working against you.
There are bid-ask spreads, there are trading costs.
And most importantly, if you use an actively managed mutual fund, there are expense ratios.
An active manager employs teams of analysts from Ivy League schools to try and find hidden value in the market.
And to pay those analysts, they charge you, the investor, a 1 or 2% fee every single year, regardless of whether the fund makes money or loses money.
The research proved mathematically that over a long horizon, the aggregate of all active managers literally cannot beat the market.
Because their massive fees act as a permanent, heavy drag on compounding.
So the indexers say the solution is simple. Fire the managers, buy a low-cost, total stock market index fund.
Let's ELI5 this for a second. Instead of trying to find the needle in the haystack, you just buy the entire haystack.
Exactly. You own a tiny fraction of virtually every publicly traded company. You accept the average market return, you pay almost zero fees, and you completely ignore the daily panic of the financial news.
The defensive investor approach.
Right. But then you read the texts on anti-fragility, and that author looks at the indexers and thinks they are completely insane.
Because of the black swans.
Yes. He's a mathematician and former options trader, and he argues that traditional finance models drastically underestimate the risk of rare, catastrophic, unpredictable events.
So if you are 100% invested in an index fund and a black swan event causes a 50% market crash, your portfolio is devastated.
And the emotional panic alone might cause you to sell at the bottom.
So what does he suggest instead?
He advocates for something called the barbell strategy. Think of your portfolio like a medieval fortress.
Okay, a fortress.
He says you should put 90% of your wealth behind massive, impenetrable stone walls, maximally safe, boring assets like treasury bills or insured cash.
So this money is completely safe from the siege of a market crash.
Exactly. And the remaining 10%, you don't put it in medium-risk index funds. You send it outside the walls as aggressive rating parties.
You put it in maximally risky speculative securities, out-of-the-money options, venture capital, asymmetrical bets.
So what is the geometry of that risk? If the rating party gets slaughtered, if the 10% goes to zero, your fortress still stands.
Your maximum possible loss is strictly mathematically capped at 10%.
Right. But if one of those speculative bets strikes gold, they bring massive asymmetrical wealth back to the fortress. You have capped your downside, but left your upside infinite.
Okay, I have to push back here. I am with the indexers on this.
You don't like the barbell.
The barbell strategy sounds incredibly sexy, but it ignores the silent killer: inflation.
That's a fair point.
I mean, if you lock 90% of your money in cash or low-yield treasuries, inflation is going to slowly eat you alive year after year.
The math proves that over 40 or 50 years, the compounding engine of the total stock market destroys everything else.
Right. The barbell feels like a strategy for hedge fund managers, not for a 30-year-old trying to build retirement wealth.
From a pure, frictionless mathematical standpoint, you are right. But from a behavioral perspective, referencing Saylor, markets are deeply irrational, and humans are fragile.
True.
When a massive panic hits, the indexer who sees their life savings drop by 40% is experiencing severe psychological trauma.
While the person running the barbell, with 90% in safe cash, has the psychological fortitude and the dry powder to buy assets at fire sale prices.
Exactly. It's optimizing for survival in an unpredictable world, while the indexers are optimizing for long-term averages.
So as a listener, what are you supposed to do with this whiplash? We have experts telling you to hoard every penny on a wall chart, others telling you to bounce your last check.
We have legends telling you to buy the whole market, and mathematicians telling you to hoard cash and buy speculative options. It feels like complete chaos.
It does feel like chaos. But if you take all 14 of these sources, lay them out on a table, and strip away the aggressive ideology and the branding, you find a bedrock of timeless anchors.
There are certain gravitational laws of wealth that simply do not change, whether you were born in ancient Mesopotamia, the Roaring '20s, or the year 2026.
Let's start with the oldest source in the stack: the ancient parables of Babylon. The mechanical rules of gold haven't changed in thousands of years.
Number 1, save at least 1/10 of everything you earn. Pay yourself first before you pay the baker or the shoemaker.
Number 2, control your expenditures.
Number 3, make your gold multiply, meaning put it to work earning interest. And number 4, guard your treasures from loss.
It sounds incredibly basic, but if you violate these 4 laws, no modern algorithm or crypto strategy will ever save you.
The second timeless anchor is what is known as the tyranny of costs. We talked about this briefly, but we need to explain the sheer violence of compound interest working against you.
Think of compound interest like the engine of an airplane, and fees are aerodynamic drag.
Let's run the numbers on that drag because people underestimate it.
If you pay a financial advisor a 1.5% fee to manage your money, and they put you in mutual funds that charge a 1.5% expense ratio, you are paying 3% a year.
Now, 3% sounds tiny. It sounds like a slightly rough paint job on the airplane wings.
But if the market returns 8% and you are losing 3% to fees, you are only keeping 5%.
And over a 40-year investing lifetime, That 3% drag will literally devour more than half of your total potential wealth.
50 or 60% of your money is just gone. Keeping fees near zero is not a preference. It is a universal law of getting rich.
The third anchor is the margin of safety. The world is ruled by chance, black swans, and unpredictable chaos, so you cannot build a financial plan that requires everything to go perfectly.
If your retirement plan assumes you will never get sick, you will never get laid off, and the market will return exactly 8% every single year, you have no margin of safety.
You are driving a car at 100 miles an hour with no seatbelt and no brakes. You must build room for error into your life.
And finally, avoiding the traps. Both the extreme debt avoidance authors and the indexers who disagree on almost everything else agree completely on this one fact. Consumer debt is a raging house fire.
Do not use high-interest debt to fund your lifestyle. Do not use leverage to invest in get-rich-quick schemes. And do not try to time the market.
Okay, we've covered the broken ladder, the psychological traps, the intense expert debates, and the timeless rules.
Now let's synthesize all of this for you, the listener. Let's bring it all home.
Say you were born somewhere between 1995 and 2010. You make a decent middle-class income.
You look at housing prices that seem mathematically absurd, you have student loans, and you are trying to figure out how to actually build wealth without being miserable. What is the modern strategy?
Step one has to be fixing your psychology. You have to actively stop comparing yourself to the generation before you.
The specific housing ladder they used is largely gone in major metropolitan areas. You are playing a different game now.
You must consciously define your own rich life. Do you actually want to own a suburban house, or do you want the flexibility to rent and travel?
If you don't define it, you will mindlessly chase the status symbols that trap people into looking rich but actually being broke.
Step two, automate and simplify. Behavioral economics proves that we are flawed, impulsive, easily distracted creatures.
Do not rely on your own willpower to manually log into your bank account and transfer money to investments every month. You will fail.
You will get tired, you will see something you want to buy, and you will justify skipping a month.
You have to build an automatic financial infrastructure. The day your paycheck hits your checking account, algorithms should automatically route your money.
X% goes to pay bills, Y% is routed straight into low-cost index funds, and Z% is left for guilt-free spending.
You take the human error, you take your own emotional brain out of the equation entirely.
Step three, value your life energy. Treat your time as your most precious, non-renewable asset.
That means being incredibly defensive against the debt shackles we talked about. If you are going to take out loans for a degree, run a ruthless return on investment calculation.
Avoid the culture of hyper-consumerism, because every time you buy something you don't need to impress people you don't even like, you're literally trading the hours of your life for it.
And finally, step 4, balance the barbell of life. We're combining the best of the experts here.
You need extreme safety on one side, a rock-solid, fully funded emergency fund in a high-yield savings account.
This is your fortress. It protects you from life's inevitable shocks and prevents you from going into credit card debt when your car breaks down.
And on the other side of the barbell, you need long-term, compounding growth assets, like low-cost index funds, to ensure you outpace inflation and capture the wealth generated by human innovation over the next 40 years.
It's about combining the absolute best of defensive structure with offensive growth.
To wrap this up, the barriers to wealth have undoubtedly mutated. The sheer cost of housing and higher education are entirely different beasts than they were 30 or 40 years ago.
The frustration you feel is valid. The math is definitely harder.
But the underlying physics of wealth, the power of compound interest, the necessity of living below your means, the mathematically destructive nature of fees, and the absolute requirement to define your own values, those laws remain absolute.
And that leads to a really interesting realization. We spend so much time debating generational fairness, but maybe the wrong question is it harder for our generation to get rich?
Because complaining about the difficulty doesn't change the interest rates, and it doesn't change the housing supply.
The right question, the only question that actually matters for your own life, is what strategy works when the rules of the game have fundamentally changed?
That is the question to sit with today.
Take a hard, honest look at your own hydraulic system. Look at your bucket. Is the water staying in and building pressure, or is your life energy leaking out through holes you didn't even realize were there?
Check those leaks.
Thanks for joining us on this edition of Amateurology. Keep questioning the assumptions, check your free ratios, and we'll catch you next time.